Right now, as we look at the live market tape, Plug Power Inc., trading under the ticker PLUG on the Nasdaq, is sitting at exactly $1.93 USD. We are seeing a significant downward pressure today, with the stock down $0.079, which translates to a decline of roughly 3.92% for the intraday session. This isn't just a minor fluctuation. When you see a stock trading under $2 taking a nearly 4% hit in a single session, it signals a volatility that goes beyond simple market noise. Investors watching this ticker flash red on their screens are currently grappling with the harsh reality of the hydrogen sector's current standing in the broader market. The expectation for Plug Power has always been one of immense, almost limitless potential. A future where green hydrogen powers everything from forklifts to data centers, creating a clean energy ecosystem that completely displaces fossil fuels. That is the expectation that led this stock to dizzying heights in past years. The reality, however, as indicated by this price of $1.93, is a much grittier, more difficult slog through cash burn, high interest rates, and regulatory hurdles that seem to move further away just as the company approaches them. When we look at this specific price movement today, dropping almost 4% to $1.93, we have to look past the simple percentage and understand the volume and sentiment driving it. This is a battleground stock. If you are holding Tesla stock or Apple stock, you are accustomed to volatility, sure, but usually within a framework of massive profitability and cash reserves. With Plug Power, the movement is different. It is existential. The drop we are seeing today reflects a market that is losing patience with the timeline for the hydrogen economy. The expectation was that by now we would be seeing massive scaling and clear paths to profitability. The reality is that we are still in the investment phase, and in a high interest rate environment, the cost of that investment is punishing. This price action suggests that institutional investors are de-risking, moving away from capital-intensive growth plays and parking their capital in safer, yield-bearing assets, or profitable tech giants like Nvidia stock, which has sucked so much of the growth oxygen out of the room. But let's pause for a second and look at who is actually holding this stock. It is a fascinating mix. You have the die-hard believers who view this as a discount opportunity of a lifetime, perhaps adding to their positions through Robinhood investments or their Fidelity brokerage accounts, convinced that the current price is a temporary dislocation. Then you have the traders, the short-term players using Interactive Brokers trading platforms to capitalize on the swings, shorting the rips and covering on dips like the one we are seeing today. This creates a friction in the price action. Today's drop to $1.93 is testing the resolve of the retail investor. It is one thing to hold a stock when it is trading at $10 or $20. It is psychologically very different to hold it when it breaks below $2. That psychological barrier is real. When a stock enters this territory, it starts to get filtered out of certain Schwab Intelligent Portfolios or SoFi Robo-Advisor algorithms that have strict criteria regarding share price and volatility. This can create a cascading effect where selling begets more selling, simply because the stock no longer fits the risk profile of automated trading systems. It is important to understand the broader context of online investing and how it shapes the movement of a stock like PLG. In the past, you needed a broker on the phone to make a trade. Now, with investing sites and apps offering investment help and self-investing tools, the speed of sentiment shift is instant. If a piece of news drops or if the broader sector weakens, millions of retail investors on the Robinhood app or the SoFi investing dashboard can react in seconds. Today's drop isn't happening in a vacuum. It's likely correlated with a broader risk-off sentiment in the renewable sector. While the Robinhood crypto crowd might be used to wild swings, the average equity investor looking at their SoFi investing dashboard sees a drop of 3.92% as a warning sign. They compare it to the stability of Fidelity mutual funds or Fidelity ETFs and wonder if the risk is worth the reward. This is the constant tension Plug Power faces. It is a technology company that needs the patience of an infrastructure investor, but it trades with the volatility of a meme stock. Let's talk about the specific mechanics of what is happening today on the chart. The $2 mark was a psychological fortress. Breaking below it and staying below it, as we are today at $1.93, opens the stock up to technical selling. Traders who use Interactive Brokers stock trading tools with advanced charting capabilities are looking for the next support level. If $1.90 fails, the technicals could suggest a slide further down. This is where the difference between Interactive Brokers platform users and casual investors becomes apparent. The professionals are looking at volume-weighted average prices and short interest ratios. They know that Plug Power has a high short interest. This means a lot of traders are betting against the company. When the price drops like it is doing today, those shorts are profitable. They have no incentive to cover yet, which keeps the pressure on the stock. But this also sets up the potential for a coil. If any positive news hits, a loan approval, a big contract, the snapback could be violent as those shorts rush to cover. This is the squeeze narrative that keeps many retail investors holding on, hoping for a rapid reversal similar to what we have seen in other highly shorted names. The volume today is telling a story of capitulation for some and accumulation for others. While some are selling out of fear, assuming the company is heading for a reverse stock split or further dilution, others are using SoFi active investing accounts to lower their cost basis. They are dollar cost averaging, betting that the company's infrastructure, the plants in Georgia, Tennessee, and elsewhere, has intrinsic value that the market is currently ignoring. They argue that the market cap has disconnected from the physical assets the company owns. This is the classic value trap versus deep value debate. Is the stock cheap because it is broken, or is it cheap because the market is irrational? Currently, the market is voting with a 3.92% drop, leaning towards the former. The skeptical view is dominating the narrative today. It is crucial to look at the sector comparison. While Tesla stock has its own issues, it has matured into a profit-generating entity. NVIDIA stock is riding the AI wave. Plug Power is still firmly in the cash burn category. In an environment where you can get 5% risk-free in a money market fund in your Fidelity IRAs or Robinhood cash management account, the bar for owning a risky, loss-making stock is incredibly high. Investors demand a clear path to green ink on the bottom line. Plug Power has been promising this turn for a long time. The expectation was that by 2024 or 2025, the gross margins would turn positive as the green hydrogen network came online. The reality has been plagued by delays, cost overruns, and a complex regulatory environment regarding the 45V hydrogen production tax credits. This delay creates uncertainty, and if there is one thing the market hates more than bad news, it is uncertainty. We need to discuss the role of the retail investor versus the institutional giants here. Institutional ownership in Plug Power has fluctuated. When you look at the holdings of Fidelity Investments or Interactive Brokers account data for large funds, you see a cautious approach. They often hedge their bets. Retail investors, however, often hold naked long positions. They are the ones feeling the brunt of this 3.92% drop today. There is a sense of fatigue. You can see it on the forums and the message boards. The enthusiasm that defined the 2020 and 2021 rallies has been replaced by anxiety. Yet there is also a resilience. Many are holding in SoFi stocks accounts or Robinhood fractional shares, treating it as a long-term option on the future of energy infrastructure. They aren't looking at today's $1.93. They're looking at a hypothetical $10 or $20 5 years from now. But to get there, the company has to survive the valley of death, that period between technology development and commercial scaling. Now, let's pull back and look at what Plug Power actually does, for those who might be new to the story or who have just seen the ticker trending on their investment apps. Plug Power is not just a hydrogen company, they are trying to be a vertical integrator. They don't just want to sell you the fuel cell that goes into a forklift, they want to sell you the hydrogen that powers it, the electrolyzer that makes the hydrogen, and the liquefaction technology that transports it. Their core business for years has been material handling, replacing lead-acid batteries in forklifts for giants like Amazon and Walmart. This is a real revenue-generating business.
It works. It saves customers money and increases efficiency. If this were their only business, the stock would likely be valued differently, perhaps more like a stable industrial equipment maker. However, the valuation and the risk comes from the ambitious expansion into the green hydrogen production side. They are building massive plants to produce liquid hydrogen using renewable energy. The goal is to control the molecule from generation to consumption. This is a capital-heavy endeavor. Building a plant in Georgia or Texas costs hundreds of millions of dollars. The expectation was that they could build these plants quickly and cheaply. The reality has been supply chain snarls, inflationary pressures on construction costs, and technical challenges. This is why the stock is trading at $1.93. The market is discounting the future cash flows from these plants because they are taking longer and costing more to build than anticipated.